Hello traders, Igor here, MrTOPTICK.com. Welcome back to the channel. If this is your first time tuning in, consider subscribing to the channel, liking this video, and sharing it with someone you think could benefit from it. Today I want to talk about power of options trading and how a few simple adjustments could completely remove any of the risk from any of your trades, as long as you have two things. One, stock moving in the right direction, obviously. And two, you have the tools to be able to see current risk profile as well as your running P&L so that you know whether you're up, down, or break even on the trade at any given time. So we're looking at a trade we did last week. This was Apple. Apple was heading into the earnings. This was Friday, October 14th. Apple was trading at about $139.48. So the idea here was to pick up an out-of-the-money call debit spread in the week where we had the earnings announcement. Earnings were out last week on Thursday. And to finance the debit spread, we were looking to sell two of the out-of-the-money put credit spreads. And the put credit spreads were about fully financing the purchase of the call debit spread. Here's how this trade broke down. So we went ahead, we picked up the 145.150 call debit spread. I paid $1.47 for the debit spread. This was a debit of $147. These options were expiring 14 days from the time when this trade was taken. And to cover the cost of this debit spread, I went ahead and I sold two of the 134.130 put credit spreads. The put credit spread was sold for 61 cents or a total of $122. So my initial debit for this trade was 25 cents or $25. However, the risk, the absolute risk, max possible risk in this trade, I had 4-point wide put credit spread and I had two of them. So that's $800 worth of risk plus the $25 initial debit. So my total initial risk was $825. Now I'm going to step through a couple of steps that were taken in this trade just to show you again how few simple adjustments could completely remove unnecessary risk out of the trade and actually leave you in a position where you have a win-win scenario. So we're going to go forward. This is 6 days from when we took the trade. This was Thursday, October 20th. What I did was, first thing in the morning, I had removed the put credit spreads. Initially, I sold those for 61 cents. And 6 days later, these spreads were trading for 5-cent debit. So what I did was I bought to close the 134.130 put spread. I paid 5 cents for each. I had two of those, so I spent $10 to do it. Now, take a look at what this adjustment did to my risk. So this was my trade before I took off the put spreads, right? I had 800 plus the $25, which was the initial debit. So a total of $825 worth of risk. Removing those spreads left my risk at $25, which was the initial debit, plus the 10 cents or $10 that I paid to take off the put credit spreads. So now my absolute risk in this trade went from $825 to just $35. And we still had 8 days until expiration. This left me with a 5-point wide call debit spread. My risk was $35 and my potential reward was $500 minus 35, or about $465 worth of upside. Now we can go ahead and move forward to the next adjustment, which was the same day. What I did was, in order to remove the remaining $35 worth of risk, I went ahead and I sold a 152.5, 155 call credit spread. I collected 56 cents or $56 for this spread, which not only removed the $35 worth of risk on the downside, it actually left me with a net credit in this trade of about $21. Now we go forward to the following adjustment, which was on Wednesday, October 26th. We still had 1 day before earnings were out. We take a look at what this trade looked like before we made this adjustment, right? So we had Apple coming down. We're down about 1 standard deviation that day. So not having any downside risk is great, but I also don't want to give up a lot of unrealized gain that I have going in this trade. So what I ended up doing, I ended up rolling the long 145 call up to 147 strike. I had collected $1.20 credit or $120 for this roll, and that left me in a 3-point wide call debit spread and a 2.5-point wide call credit spread. Now, if you look at my risk, or what was the worst case scenario in this trade, if Apple, after earnings were out, by Friday, 4 o'clock, if Apple is under 147, I stood to make about $141. And if Apple was above 155 on a Friday after earnings were out, my max potential return was going to be 141 plus 50, or about $191. So let's remember, my long spread is 50 cents wider than my short spread. So I had, on the downside, I was going to make either $141, or if Apple was above 155, I was going to make about $191. And that's not accounted for any commissions or fees. There was a bonus if Apple was somewhere between 150 and 152.5. At that point, my 3-point wide call debit spread was going to expire for its full potential value, which is $300, and the 152.5, 155 call credit spread was going to expire worthless, giving me a total profit of $300 from the long call spread, plus the $141 in credits that I have collected so far in this trade, giving me a total potential reward close to about $440. On Friday, Apple actually ended up closing just above 155, so this trade did show a profit of $191. I hope you liked this video. Please subscribe to the channel, like this video, and share it, and we'll see you in the next one.